And clearly, the big story has come in from the Apex Court in the Essar Steel case, where the Supreme Court has upheld the primacy of bankers over operational creditors. So essentially, financial creditors over operational creditors in cases of bankruptcy. Ashmit Kumar, my colleague who was tracking this very important case, joins in with the details. Ashmit.
Well, a hugely important verdict coming from the Apex Court, a verdict that in many ways vindicates the IBC the way it stands right now, and in many ways also comes as a huge relief for lenders, not just in this particular case. Of course, they will be in receipt of as much as 42,000 crore rupees in this particular case, but it also lays down the law of the land as far as the IBC and pending dues in very many other cases is concerned. Now, what are the takeaways from today? Well, there are four broad takeaways. The first is the primacy of the financial creditors. Is there what happens in the relationship between a financial and operational creditor in a pending resolution case? That question has been answered. The NCLAT had treated both of them at par. That NCLAT judgment has been dispensed with, has been done away with, has been junked by the Supreme Court. The Supreme Court restoring the primacy that financial creditors enjoy over operational creditors and ensuring that the waterfall mechanism is respected. That's the first key takeaway here. Financial creditors getting a one-up. As far as the other takeaways are concerned, the second key takeaway is the power of the COC. Here again, the NCLAT had held that the COC is not the competent agency. That question again has been turned around. The Supreme Court clearly pointing out that the COC enjoys the power, that they have the authority, they are the competent agency for deciding on distribution of funds of the bid amount. That power has been restored. The third key takeaway is the jurisdiction of the appellate tribunal of the NCLAT and the NCLT. The Supreme Court has held that they do not have the power, they do not have the jurisdiction to tinker with the COC plan. They can at best send the plan back for distribution back to the COC. They themselves, the appellate tribunal itself, cannot tinker with it. And that brings us to the fourth and the final takeaway, and this is with respect to the IBC. The IBC amendments, the IBC Act has been upheld, except barring one exception, wherein the timeline of 330 days had been provided. There, the Supreme Court had clearly held that the mandatory timeline, the mandatory nature of this timeline is taken away with, and that in exceptional cases, the appellate tribunal will have the authority to extend the timeline. So those are the four broad takeaways. Hugely important verdict for the entire ecosystem, as well as for the lenders in this particular case. Huge vindication coming in for the IBC.
Ashwin, thanks a lot for that. With that, we take it straight to Page Industries. That stock is buzzing in trade. Remember, the company reported a mixed set in the second quarter earnings. However, the management commentary in the con call with regards to the margins was fairly positive. We have Mr. K. Chandrasekhar, who's the CFO of the company, joining us on the phone line. Thanks a lot, Mr. Chandrasekhar, for joining in. First half, your top line growth has been 7%. Historically, it has been over 20%. How does the second half look, and when do you go back or aspire to go back beyond the 20% mark?
Thanks. Congrats on your 20th, celebrations, 20th year. Thanks for having me on the call.
Right, Mr. Chandrasekhar, thank you for congratulating us on the 20th year, but the number that stands out for Page Industries is 20. Remember the management earlier saying as well that you all have grown at 20% in the past. This year, first half, you've grown just 7%. When do you aspire to grow at 20%, and how does that second half look for you?
We have grown 12% in Q2. Volumes have grown by upwards of 9%. So it is certainly a reversal of trend compared with Q1. It is a bit too early to call on a long-term basis, including on H2. We have historically prepared for a double-digit volume growth and will continue to do so the way we prepare our production and the channel partners. That is the way we do. But given the economic scenario, we would observe over a longer term. And therefore, this is not a guidance, but we do prepare for a double-digit volume growth.
Okay, Mr. Chandrasekhar, good afternoon, sir. Thanks much for joining in. How are things on, say, the competitiveness front? I mean, are you facing any pressure over there? We're seeing some of your competitors are growing as well and, picking up pace. Do you notice things changing?
We have said in the past that the market is quite huge in India, and the penetration in the premium market is pretty low. And so there is a room for the premium space to be grown by even some of our competition, and some of them are doing well. They have done well in the past also. So if we look at we only look at the penetration in the premium market, where we have close to 18% for the men, about 5 to 6% for the women's segment, and about 8 to 10% for the athleisure and sports.
You know, Mr. Chandrasekhar, while we take your point that the market is large enough, over the last, say, 1 year or so, the rate at which Van Heusen has grown, it looks like a majority of the incremental market share has gone to them. Has that affected you, the growth of your peers, albeit small in absolute size, but incremental market share loss? Is that something that Page is facing?
From what we have observed, the nearest competition that you're mentioning is about 6 to 8% of the volumes that we do. So from a small base, definitely there is room for growth. And our feedback is that this has grown at the expense of some of the other premium players rather than Jockey itself.
Okay. What about margins from here on? I think the first half has come in at the 21% mark. Will that remain ranged between the 20-21% mark from here?
20 to 22% is the EBITDA margin we always achieve historically. We also plan an annual price increase so that we achieve that, and it is pretty much intact.
I'm not too sure whether it is intact or not, Mr. Chandrasekhar, because 20 to 22% earlier that you did was X of the Ind AS accounting norms, and now with the accounting norms there would have been an impact of almost about 200 to 300 basis points on that. So would you increase your margin target going forward? That is number one. Number two, you're talking about premium products, contributing more, athleisure contributing more, women's wear contributing more. Aren't they supposed to be margin accretive?
We typically only price for a 3 to 5% increase once a year, and the price increase is inflation plus. So we don't increase price unless there is a cost increase. So that 21% becomes our targeted EBITDA margins. And to your earlier question about the margins being under threat, Ind AS has got only about 2 million impact as far as Q2 is concerned on the bottom line. And in Q1, it was about 4 million. So it's not a very significant game changer as far as Page Industries is concerned. But at the EBITDA level, there has been some decrease due to Ind AS.
Have you taken price hikes this year so far, Mr. Chandrasekhar?
We take price increase over a period of many months. We don't do price increase overnight for all the styles put together.
What I'm trying to get at is that the last quarter you indicated that there were some discounts, consumer price offs that you had given as well to drive growth if you must. But now you're saying that you're looking at some price hikes as well. In this environment, are you able to do that?
We haven't given any discounts. We only run the sales schemes in specific markets and in specific categories. So we sell at MRP across all online and offline channels, and we do not do any discount for any off season. So we are absolutely an eminently affordable premium apparel brand, and we represent value for money for all our customers. So our business model does not include pursuing discounts to push the sale.
All right, and final question before we let you go, Mr. Chandrasekhar. You keep saying that you are a premium apparel brand, but now over the last few years, we have seen incremental competition coming in at the premium end as well from foreign players. But one of the questions that the market has is your policy of dealing with dealers. Some even call it high-handed. Will there be any change in that, given the liquidity concerns right now?
We have close to nearly 2,500 plus distributors dealing with all the categories, and they have most of them actually have stayed with us for more than 10 to 20 years. So we have grown because of the support of the not only the distributor community but the entire channel, the retailers. We have now crossed more than 62,000 multi-brand outlets. So we have expanded to 680 plus exclusive business outlets. So a one-off sample will not actually represent the reality in the market.
All right, Mr. Chandrasekhar, thank you so much for joining us and giving us the outlook as far as your growth and various other parameters are concerned. Margins likely to be in that 20 to 22% band. The second half looks incrementally better, and he aspires to do double-digit volume growth. So that is something we'll definitely keep an eye out on. Though important to know that incremental market share is more important for Page Industries because there has been some competitive intensity too. On that note, we'll take a short break, come back, and we get on with your stocks where we answer your stock and investment related queries.